The market will be taking in the latest decision from the Federal Reserve on Wednesday, though it's become quite clear that the event risk will most probably be a lot less about the decision and a lot more about the overall tone. The expectation for a third rate hike from the Fed this year has been all but baked in, and it will come down to whether or not the Fed decides to color this with a hawkish vibe or one that leans more dovish. If we're to use economic data as the determining factor, the bets calling for a hawkish hike are certainly looking good and justified, with US reads very supportive of higher rates and arguably at a faster clip than what has already been projected. US growth is looking good while unemployment sits at multi-year lows, and even wage growth is moving up, albeit less than what is optimal. We've also seen an interesting shift in the momentum of all things forward guidance, with 2018 a year in which the market has been playing catch up with the Fed's expectations versus the many years we've seen post 2008 crisis in which the Fed would be needing to move back towards the market's calls for a more accommodative stance. And so all of this would suggest we could see the Fed deliver this next rate hike with a more hawkish leaning, dollar supportive tone than what the market might be expecting. As far as the language goes, there are many hawks out there looking for the Fed to remove language describing policy as accommodative, with rates back to levels that would more accurately define policy as closer to normal. And so this is one side of the coin. On the other side, however, we can't dismiss the possibility the Fed still manages to produce a dovish slant to the decision. While the pickup in the economy has been a big positive, the Fed has also highlighted its readiness to slow things down if downside risks become more of a threat. The biggest downside risk out there is the downside risk associated with escalating global tension, driven by the U.S. administration's alternative take on how its relationship with other countries should be when it comes to trade. The Fed has demonstrated many times over the past several years that it's more than capable of redefining things when it comes to forward guidance, and we wouldn't be surprised if this translated to less of a focus on solid U.S. economic data and more of a focus on worry about the impact of U.S. trade policy. Moving the goalposts when it comes to forward guidance is not something the Fed has been uncomfortable with. With all that said, if we revisit the possibility that the Fed drops language describing policy as accommodative, it could also be argued that this would be much less hawkish, in that it could mean that with rates closer to normal, a long pause could be on the horizon. Overall, we think it's also important to be aware of where we're at in the cycle and how politics are playing a big role in financial markets. As far as where we're at goes, we are now at a point where investor immunity to negative shocks is no longer what it once was on account of this shift away from ultra accommodation into normalization. This means any upgraded concerns about downside risks like trade wars could have a more dramatic impact on U.S. equities. As far as the politics of it all goes, it's been very clear that the U.S. administration continues to push forward with its agenda, an agenda that promotes a soft dollar policy in order to achieve its objectives. All of this suggests that whatever the case today, the prospect that we could be getting very close to a more prominent theme of risk off, dollar off, is not a prospect that should be taken lightly. As far as levels go, if we're to use the euro as a proxy, pay attention to the June high around 118.55 and recent support down towards 115. A break on either side will be required for a better indication of direction and that next big move. That's all for now.